You guys have your mics and
Harry, are you on?
Step off.
Yeah.
Okay. Are you good?
Yeah, I'm good.
We good? Okay. Hello, everyone. Hello. Thank you very much for coming along to Library Mistakes Day. As you'll notice, the first thing is Russell's not here, so you don't get that terrible, ridiculous clanging bell that he does when he wants to get people's attention, which I dislike intensely. And it's great because we don't want to have key man risk here, so it's great to have others doing it, others doing the show. I just wanted to say before we start, and again, Russell hates me doing this because I'm always on the sell, but we are a charity. We depend on your goodwill. Thank you very much, any of you who donate to us when buying a ticket. There are other QR codes around here if you want to set up a regular donation to the library. As well, we have our courses, as you know, the online and in-person courses. The in-person course is taking place in London and in May and in November of this year. And if you book before the 31st of March, there's a 10% discount on that. Well, I think that's everything that I need to do in terms of selling. And I'm now going to hand over to Charles and Harry.
Thanks very much, David. Good evening, all. Welcome to the Library of Mistakes. Welcome to the next in our series of extraordinary fund managers. Harry Nimmo of Standard Life, Aberdeen, and all the other names it's operated under. I think Harry's expertise is especially interesting right now. I mean, European and UK, small cap and mid, this is stories that have been less than in favor for the last little while, but suddenly might be becoming more popular. Harry, as an introduction, Harry started in financial markets in 1985. He built a franchise on behalf of Standard Life in Aberdeen from scratch, one that ended up running £10 billion in assets under management, a great success. The team produced some pretty spectacular performance, and you can see some of the numbers up there. And won a multitude of awards. I did quite like the #1 spot out of the top 100 fund managers in 08 and 09. It's always a nice place to be. Also, I quite like the one mentioned here where you get the second best performer in any category. So Harry and team can claim to be the second best fund manager of the century. I thought that was a good one to have in your back pocket. But equally as impressive as this performance is the compelling stories, the companies that are behind these numbers on a screen, and I think that's great. It's interesting to hear about those living, breathing companies that operate always, and that is a vital role of financial markets. So performance on one hand, also understanding of the companies, the stewardship. And the storytelling is another key part of that. Also something I think we should all be impressed by and never take for granted. Harry was able to do this with a small team, sometimes very small team. And so to be able to find that very effective blend, to be able to identify that effective blend between philosophy and process, something that Hugh will explain a bit to us called the matrix. Ominously called the matrix, but also matched by an instinct. And we've been chatting a bit about it, that instinct for identifying great managements and great companies. So, you know, it's art and science. Also, another one I think is important, and you'll see this as we chat through, knowing when to sell is as important part of the process. To consistently find tomorrow's winners is a very rare skill, and Harry and team were excellent at that. So could you please join me in welcoming Harry to the Library of Mistakes? So over to you, Harry. We thought we might start with a bit of your backstory, what you think were the important bits along the way.
Well, I come from a very traditional background in Edinburgh. I went to a paid-for school, as did 25% of the population of Edinburgh. I was always in the C stream. There was A, B, C, and D by how you scored in your exams. I was in the C stream. I ended up going to Dundee University to do geography. And I'm sad to see that, or hear that that university might not be long for this world, given its financial state at the moment. It seems to be going in the wrong direction. I then went off to University of Glasgow. I did a survey diploma, and I became a land surveyor, the theodolite and level type. And I worked in the Middle East, in Saudi Arabia, for 3 years in the oil and gas construction industry. And then I realized that the future Mrs. Nimmo was not to be found in Saudi Arabia, so I better consider a change of career and a more sedentary existence back in the UK. And the beauty of working in Saudi Arabia, there was very little to spend your money on. You couldn't buy any drink. You were paid in cash monthly. So you went through this rigmarole every month of counting your wedge of folding money and then sending it along to Al Raji, or going along there to the money changer, and then you'd send a check back to the UK. And I just asked my dad to invest in stocks and shares, and he did. And fortunately, able to, after 3 years, to buy a flat in Marchmont and go back to university. So I went back, I did an MBA at Edinburgh University, and then I started as a graduate investment analyst, aged about 28 in 1985 at Standard Life on the US markets. And then I moved on to UK large caps and then smaller companies in 1993. And all they had at that stage was internal money. This was their life fund and their pension fund, their smaller company allocations, a very low margin, and there was no external money. So we launched our first smaller companies fund in 1997. Following that, we got 5 million of seed capital, and it took 3 years to actually get £5 million of external money in. You need a track record. I didn't have an external track record at that time. We took over an investment trust to build that business. We launched a European smaller company fund in 2007, and then a global smaller companies fund in 2011, 12. And then moved on to UK mid-caps, to global mid-caps as well, just to broaden out the franchise. And it all went swimmingly well until the end of 2021. And then things have become a lot tougher since then, which we can maybe talk about later. So that is the short history of my career, which involves spending 37 years at Standard Life and Aberdeen, as it became.
I'd love to, when we were chatting about this, I mean, one thing that if you're happy to jump back to it, was the US time, the time on the US desk. Any names you want to name there? Any stories you want to give us?
Okay, well, you live and learn in the investment business, and you need to pay attention to what's going on. And there is a story here. I was a junior. My boss, his name was Bob, and I decided to go off to Australia to meet a good friend over there, spent 4 weeks in Australia. But I knew that Microsoft was coming to the market, was listing, an IPO as they call it in America. And there's this guy, Bill Gates, who was coming over. He was going to London, he was coming up to Edinburgh. And I was the technology analyst. And I remember saying to Bob, whatever you do, you have to go along and listen to Microsoft, listen to Bill Gates, and you must buy shares. This one looks like a total winner. So I went to Australia, and then I got back, and I said, oh, okay, Bob, how many Microsoft shares have we got? Well, none. I didn't go along. What? What did I tell you? And the shares were already up 80% by this time, within a week of listing, and I thought, oh, we've completely missed the boat on this one. So I just ignored it. Now, that's what I learned. Winners can sometimes go on being winners with positive momentum for many, many years. You don't know how long, maybe a couple of years, maybe 5 years, 10 years, 20, 30, 40 years. But momentum, just because something's gone up a lot doesn't mean it's suddenly going to go down. It could go up an awful lot further. That's what I learned from that.
Yeah, I mean, it's got to be one of the saddest things not to have invested in Microsoft. But equally, if that taught you a lesson that allowed you to do what you've done, definitely worth it. Should we?
Let's move on
do
to
you
the
want to?
process.
Yeah, talk through. Well, we've talked about sustainable growth and buy for the long term.
Okay, so
It's certainly one of them.
you have to have a strong process that works and that is easy to understand for investors. I think these are the key things. And we came up with, well, first I should say, who is the theoretical basis for this? In the late 90s, I was casting around for an investment process within Standard Life that works. And there was an awful lot of stuff going on. It seemed like everybody was almost doing their own thing, and they were trying to unify this. But an ex-colleague called Jeff Saunders, who I believe is in the room, could you put your hand up, Jeff, came up with this paper. It was about 40 pages worth, called Dynamic Stock Selection. And it had a byline, post-Keynesian, neo-Freudian behavioral finance.
Brilliant, absolutely brilliant.
Jeff is very cerebral, but he's rather apt to sort of basically over-egg it on that script. Well, it came down to run your winners and cut your losers. And he came up with all sorts of things. There's a lot of talk of Freud, a lot of talk of Keynes. They were a particular fan of these people. The availability heuristic, decision regret avoidance, and the sunk cost fallacy. All these things that he talked about. He quoted lots of eminent economists and the like. And what he was dead against, which I actually agreed with, was the traditional investment theory that was around at the time. And if you know all this stuff, capital asset pricing model, the efficient markets hypothesis, it was the standard format. These are people, Markowitz and the like, from the 1950s and 60s, who said basically, you can't beat the market, so there's no point in trying. And that's what, as an active manager, we were trying to get away from and show that a manager with a good process could actually beat the market. So the gist of this we refined, and we created the matrix. This is a name check for another person here, Simon McCallum, who's in the room. Simon, hands up. He, I think, so it's going back into the Mr. Simon. Jeff and Simon could fight about it later, but Simon's kind of created the matrix, which is just a glorified spreadsheet that picked back-tested factors that were predictive of share price performance. That's the gist of it. And the main one came through in growth, quality, and momentum in the long term. And the idea is if you run your winners, you buy winning companies that are improving, and you back them until they stop improving and they roll over. And this can all be tabulated in the matrix. No system is perfect, but it's definitely helpful. And it's even
Harry, just give us a second. We're going through a technical. Everyone, take a second.
Sure,
we have a technical issue.
I think that microphone is misbehaving, so I'm going to take that one away. Sorry about that. Do we have interlude music? You can do a trick there, Charles.
We can. If you need to listen to me sing or tell jokes, we really are in deep, deep trouble. If you go right, maybe.
And the beauty of it. Is that any good?
That sounds good.
Okay, the beauty of it is, if you're running smaller companies, there are hundreds, if not thousands. On a global basis, there are thousands of stocks to choose from. And Standard Life used to pride itself, and as many other companies, we cover every stock in a large company. We cover them all, whether we like them or not like them. Smaller companies, you don't have that benefit because with smaller companies being a small part of the market, you don't get allocated. I didn't have a team dozens and dozens of analysts. So I only had a very few people. So you only research companies that are actually going to make sense for your portfolio. So if you've got a matrix, it cuts the number, let's say in the UK, down from 600-700 companies to about 100 companies that fit your investment process, and then you research them. So it's not about, you remember quality and visible quality, and I maybe should say a little bit more about these things. Earnings visibility is very important. That's about quality and growth. Things like companies that know where next year's revenues and profits are coming from. You know, some companies get paid a year in advance for their business. Others get paid a year behind, okay? Now, what's better? You've got your client's money for a year, or you're actually financing your clients for a year. That's called negative working capital if you have your client's money for a year ahead. And some companies can even go further, 5-year contracts, getting paid a good slug of that in advance. And these are far more reliable, predictable business, because we want to take out the risk. I think that's important. Investing for the long term is important. That's where you can make hundreds and hundreds of % of return. Also, if you're managing large portfolios of smaller companies, there is a liquidity issue. You can't get in or out of stocks quickly. It sometimes can take months. In our funds, we would own, well, in the individual funds, we might own more than 5% of an individual company. So you had to be in there the long term, or you'd be stuck with it. And that's important. Management longevity and quality were things we liked. We liked founder-run businesses and companies run by companies, or rather, individuals running companies that ran them for many, many years. And this is the final one, point 6. Valuation, in the traditional terms, things like dividend yields, price-earnings ratios, were secondary. We did include them in the matrix to kind of keep us honest, but they were secondary in terms of stock selection, because particularly in smaller companies, they're often, individual companies are cheap for a reason, because they're about to go out of business or issue a profits warning or something like that. So you don't want to get involved in these companies. They will have higher valuations if they're any good. But investors tend to only look at a few months ahead, and companies that can generate positive momentum in the long term are what you need. And this is where we come up with the term earnings revisions momentum. I'm sure many of you have heard about this. And the point here is the sell-side analysts, they have their models. We never kept any models. Didn't keep any spreadsheets of P&L accounts. We never tried to second-guess the sell side. They did that. These are people that may only cover a dozen stocks, and they kept their markets, their models, and they adjusted their P&L accounts, their balance sheets, all that stuff. What we were interested in, these analysts, they publish forecasts, earnings per share forecasts, and then they'd get a steer. The finance director would call up and say, "Look, Jimmy, your numbers are a bit low. You might want to re-examine them." And then they'd rush off and they'd come up with an earnings upgrade. I hope I'm not saying too much here. I don't want to give the wrong impression.
The old days. There was the old days.
Or it could work the other way around. A finance director's what they hate most? Issuing profit warnings. That's what they hate most. So this is just my thinking out loud here. This is all thinking out loud, by the way, for those that are watching or recording. They hate to issue profits warnings. So the thing to do, if you know things are going bad or wrong, just sort of put it out there amongst your followers that you're maybe a little bit high in your earnings. And so to getting to the wrong answer to the right answer is like a multi-stage process. And this creates what's called earnings revisions momentum. And to be honest, our back testing for earnings revisions momentum, it was easily the best factor. And this is followed by price momentum, and then other ones, growth, straight growth, and the quality measures. We had a couple of really oddball quality measures. There's one called Majeski scores. I'm still not 100% sure I understand what they are. You have to ask Simon over there. Sorry
Harry's a big picture person. Harry's a big picture person, not too tied up in that.
So anyway, these are this is the matrix. These are the 6 rules.
I think I think it's fascinating. I mean, what's interesting, they had the glorified spreadsheet, and as a fan of a spreadsheet, I think that's a lovely way of putting it. But it figured out different things that worked for you. Art and science, the gut, the instinct, and so on and so forth. I think it's very interesting. I mean, distilling down, having had a few chats with Harry, it is that point of you have growth. You have to be able to judge the management. You have to be able to judge the quality of the business. And then you see the growth. But the ones that are really exciting is where the growth is accelerating. And that's the revision upwards. And that makes a difference. And what I think is brilliant is when we start talking about specifics and the stories and how this actually plays out. Because what's astounded me, one of the things that's astounded me most about this, and there's many things, but is just the number of winners you're able to spot and the numbers you were winners to spot early using this process. So as an example, we were talking about this one, so over to you and talk about the 1997 portfolio.
Okay, well, just completing what you said, I mean, spotting stocks that are rolling over, you're never going to spot the top. You're never going to get the top. Nobody can ever predict the highest point a share will reach. So you may decide to sell out of your holding when it's down 30% from its highest point. And that's possibly the right thing to do, particularly in smaller companies where things can go to zero. And you've got to do that. And because many investors, they'll think, well, I cannot sell for less than what I've paid for a stock, or the shares have fallen from its high. I've got to wait until it's back up to its high. Just remember, markets are changing. It's a dynamic market out there, and that means valuations are changing, and stock prices will change as well. So that's important to remember. So I found this sitting in my in a box in the cellar. It's the first unit trust report and accounts for the Standard Life UK Smaller Companies Fund, dated, this ends at 31st of May 1997. So I thought, well, it had the full portfolio in it. So I thought I'd better have a look, see what happened to these stocks. How many did they disappear? Did they do well? Did they do badly? Now, obviously, I'd have refreshed the portfolio, but this is really bringing this portfolio up to date. And I tried to include names that you might have heard of and names that are possibly still around. And everybody remembers Robert Wiseman Dairies, although maybe you're quickly forgetting because, much to my annoyance, Müller, the Bavarian company that bought it, have taken away the name. They call it Müller Dairies. And it's still Scottish milk and British milk that's being produced. It's not being shipped over from Bavaria or anything like that. So Robert Wiseman Dairies, they sold out. Alan and Robert, the people we met who built the business, did a fantastic job, and just shows you the most mundane things can create a good business. What they did was, if you remember milk, everybody got it delivered to your doorstep, and basically a very mature market, not growing. So the dairies, Dairy Crest and Associated Dairies and the like, they hadn't really invested in their new dairies. So what Robert and Alan did, they could see a change going on. They built a brand new dairy. And think about milk, little known thing about milk. If you keep it below 4 degrees centigrade, it will last for a couple of weeks or something instead of a couple of days. And that means, and the supermarkets were just starting to get going in the 80s and 90s. So really, milk moved from being doorstep delivery to being supermarket milk. And Robert Wiseman, the first person to have modern dairies to cater for that, built dairies in Aberdeen, in East Kilbride, Droitwich, in I think in Manchester, further south too, and now they're they became a 30% of the UK milk market, and that's a huge success story. And arguably they may be right to sell out because that business has become mature as well, really. So Shire Pharmaceuticals, to be honest, I've forgotten quite a lot about that, but it's been a huge success story, and it was acquired a few years ago. It was a biotech stock, an acquisitive biotech pharmaceutical stock that we owned at the time. Ashtead Group is a great stock. It's plant hire. And that was a change going on in the construction industry. They didn't own their own stuff. They basically borrowed it, rented it. And Ashtead were the originators of this, and they have I think they're now called Sunbelt, and they're very big internationally as well. So they created an international business. Bellway, a house builder. Everybody knows Pizza Express. In when they had a few shops, and they sold out about 15 years ago. Greggs has had its ups and downs, but generally been going bottom left to top right. This is the sort of share price chart I like. Bottom left to top right. That's what we need. That's what we look for. And Greggs has had, it was originally a family-run business. What they did, they converted themselves from an old-fashioned baker into a food-to-go business. That was the gist of it. And Mike Darrington and various other people were important in that. They became a national company, 2,500 shops. They opened in Belgium, selling sausage rolls and things. Complete failure.
Better one.
And JD Sports. This is John Wardle and David Macon, and they started it in the 80s, I think, and they listed in 1997. I remember when they listed, because there were quite a few old fund managers around, and they were selling, trainers for young people and stuff. And I just remember this. One of the old fund managers said, "Well, what about the competition from Marks and Spencer's?" And I remember one of them said, I better not swear. We effing, our clients, our customers, effing hate Marks and Spencer's, which I suppose is fair comment and sets them apart. And I should point out on this one, the sales signal for me for this was, and this is sometimes little subliminal things happen. The sales signal was when my mother-in-law, aged 86, bought her first pair of trainers. And this was about 5 years ago. And it's then I realized that market is mature. It's definitely mature.
Saturation, not just mature, saturated.
It's not growing.
Run us through, it's incredible the number of names in that portfolio that everyone, as you said, Pizza Express, Greggs, JD Sports, especially back then when they were much, much smaller franchises. Run us through some of the less than exciting ones.
Okay, right. Well, just these Stanley Leisure, there's a story there.
Go on.
I remember Stanley Leisure owned casinos. A guy called Leonard Steinberg owned casinos and bookmakers. And you remember they opened a big casino down in Leith, just the entrance to Leith Docks. So I got a call from Leonard Steinberg. He says, "Harry, he came from Northern Ireland. Harry, would you like to open the new casino we got here in Edinburgh?" And I said, "Yeah, I'd love to. It sounds fantastic." And then our head of PR got to hear about this. He says, "On no account can you open a casino." Because all the wrong messages about investing in equities. So there we go. So the other one, the less successful ones, well, Cortex was a company that is a biotech. They didn't have any revenue, no sales. So this is quite common in biotech companies. They had an idea and a product in phase 2. And what this idea was it was oral calcitonin for diabetes sufferers, and this is a huge thing. You have to inject yourself regularly, and it sounded brilliant. There's a fast-talking Australian, and they're great at this. And this is what you do have to do in biotech. You need to talk a good game. You really have to convert the fund manager because you have no revenues and profits to talk about. And I used to get a lift down the road from a guy who was professor of oncology at one of the universities, and I said, well, I've got this thing, Cortex. It's brilliant. It's got this oral calcitonin. And he said, where does it come from? I said, I think it comes from a salmon. A salmon. It's a salmon calcitonin. And he just said, it'll never work. Calcitonin from a fish. It's ridiculous. So I sold the shares, and it did. It just disappeared. It completely disappeared. So independent insurance was once the largest holding in the fund, and it got into financial difficulties because I believe, and I have to watch what I say here, but they weren't using the proper rules for insurance. You have to calculate based on back history whether you're going to have to pay out or not and how much, So, and you spread it across thousands of product categories and people, and they just basically hadn't done that properly, and it just failed. Molam construction company went bust. Anglian Group, I'm not quite sure, they made replacement doors and windows. Probably not a good idea to invest in the long term in a building sort of company like that. API Group, paper and packaging company, and this is what you saw in the 90s in particular, whole sectors of UK smaller companies disappearing, paper and packaging, textiles, chemicals, stuff like that. I'm not sure I even want to talk about the other ones. Regent Inns owned a load of pub concepts, including something called Jongleurs, comedy pub, Walkabout Inns, an Australian concept, Old Orleans Dining, and Surfers Paradise, and it eventually failed. And there's an idea, actually, you probably don't want to be in the pub industry because it's declining. It's been declining for 30 years. And the only pub company we invested at listing in J.D. Wetherspoon, and it benefited from what's called the beer orders, where actually I don't think we've got time for all this. Anyway, I think let's move on.
I think it is really worth saying. Look at the bottom line for those of you who can't see it. 7 went bust, 17 bids, 3 got to FTSE 100, and fascinating.
40, look at that. 60% of them have gone bad,
and even 7 going bust. It's an extraordinary. Actually, I think it goes to, and we can talk. We can talk forever. We could talk about the process and how how that was able to get rid of these and make sure you kept enough of those. But it's fascinating to see it how much you changed that over time, how much you had right in 1997. But it is fascinating to see it. As we were talking, the process worked because it was able to identify these companies early. It was able to hold on to them for a long period of time, which made amazing money. It was also able to not get dragged down by these ones. So I think that's brilliant on that one. Anything else on this?
That's a fair comment. And we had a sort of rule of thumb. If the matrix, you had to keep the matrix score. We watched the weighted average matrix score, and we kept it above 10. 0 is average, -10 is and below is sell, and 10 upwards is a buy. And so you made sure that your weighted average matrix score was at least in high single digits, 8 to 10. And if you saw a stock that was -10 or less in your portfolio, you don't want to hold on to that for more than a few months. Maybe 6 months at the most was a general rule I took. Am I giving away too much here? Maybe not. Okay, so that's kind of. So it was a simple decision-making process, and you have to watch yourself. Smaller companies in particular, the chief executive, sometimes they get a bit stroppy when you start selling their shares. And if you have another meeting with them, they start giving you grief. And if you can say, well, the matrix, it's nothing personal. The matrix made me do it. Was quite a useful line. But occasionally, this is another rule. If you decide to sell a stock and you might have 7 or 8, 10% of it, don't bother meeting the management again, because they'll just, particularly if they'll just give you grief. And sometimes, I remember an ice cream company, which I won't name it, but he was terribly friendly. We went down to see them at a place in Yorkshire. We sat around the boardroom table eating ice cream, all sorts of different ice creams. Really great, a real charmer, and his three-piece suit and all that. But then after a couple of years, we thought, oh, we'll sell. And we made the mistake of accepting a company meeting. And he came up, and I just remember him. He was looking out the window. He wouldn't turn around to say hello or anything. He just said, "You're selling our shares." And then he got really abusive. And I just had to say, well, look, I think we just stop the meeting here. This is after a few minutes. And that was the end of it. And I thought, now I learned a lesson. I got them to sell it as quickly as they could. And stuff like that that's a bit of a sell signal, I would say. If you get vibes like that from companies, I can understand it. I mean, he was maybe trying to buy a business or raise money, and he is a bigger shareholder trying to sell the shares, and he's going to be depressing the stock. And it's a business that he's built, and here's this fund manager, who's some Ponzi fund manager, who's busy trying to destroy his business. So look at it from their point of view. Maybe you can understand why actually get a bit shirty about a seller.
But equally, they have to be able to survive without you. They have to be able to move on. So, that is part of our business. And again, one of the things that I think is brilliant about the process is that you were able to exit positions just as effectively.
And it's not pure self-interest. We have helped out companies. Particularly, I remember after the COVID crisis, many companies were in good companies in comparative financial difficulties because they had to close down. And, we took part in quite a few kind of emergency rights issues at that time to help them get through. So I thought at the time, this is sort of stock markets and capitalism kind of doing the right thing. And, we can come on to the new issues market at some stage, but maybe we should move on.
Yeah, no, we will definitely come back to that one. We'll skip over these ones because these are the glory slides. Yeah, well done, Harry. But you can see, I mean, this, again, to say basically 11 of the top of the current FTSE 100 were way back when is an astounding number. And that is actually ignoring the fact that there's another 3 that just don't happen to be listed anymore and or listed when they're listed in the US. I think it just, it's incredible how effective that was at identifying these amazing businesses, but also identifying them early enough that you're able to pick them up and grow with them. So,
well, you're very polite here, but what does strike me recently? Well, how big is Apple right now? Well, I think it's 2,500 billion market cap. Biggest company we ever invested in has got to 100 million. 5% of that.
100 billion, yeah. 100 billion.
100 billion, 100 billion. 5% of the size of Apple and Microsoft and Nvidia, all these other ones. So maybe we've kind of, we've not done as great a job as Charles, you're saying we have. I mean, Flutter. You remember Paddy Power? That's what's become Flutter. It's a global leader, the global leader in online gaming. And look at all these ones. I mean, they're not that big. You don't need to be that big to get into the FTSE 100 these days. Which maybe says something about the state of the UK stock market. And one of them, Games Workshop, I mean, they're selling little sort of paint-your-own games, Warhammer games to teenage boys. And they're in one of the 100 largest companies in the UK. It's a fantastic company. And this is another little sign. Even a tiny little niche, if you can internationalize that business, it can become very, very large indeed. And Games Workshop makes incredible margins, and it's 200 or more million of pre-tax profit. It's big.
Let's jump on, Harry, because I'm just aware that you and I could chat about this for a while.
Okay.
Sorry. We'll go back one. Again, this is another glory slide. Things that just did incredibly well for you over time. I don't know if you want to talk about that one or.
We'll come on to this later because many of these companies have, they haven't quite died a death, but they have gone down an awful lot in the last 5 years. So I was just trying to emphasize the dynamism of stock markets. Things change, and you mustn't fall in love with companies, and you must remember when to sell and use your sell signal. And this is where the matrix came in handy. ISOS is down 90% in the last 5 years. Fortunately, our end price for our 8% holding was about 85 pence, and it got up to £72. 10 years later, and our average exit was £47. And I remember thinking after we got rid of it, oh my God, we've not done a good job here. We're 30-40% below the high, but actually it was a good job. Fever Tree Drinks has come off a long way, but that was absolutely fantastic in its day, many times the money. And this is the thing about these companies: you can make many times your money if you run your winners. Capita, it's an outsourcing company that was hot in the 1990s. We haven't owned it for 20 odd years. YouGov is an interesting situation. It's a digital market information brand index analysis of brand. It's got a very strong business model. They sell sort of annual or longer contracts, I think. They get paid in advance, that sort of like. Actually, the founders, one founder is Stefan Shakespeare, and the other one you'll have heard of, Nadim Zahawi, who then went into politics, the Conservatives. He was Chancellor of the Exchequer very briefly. But it was a great business, and the polling was simple marketing, really. It wasn't a big profit generator for YouGov. But if they got the polls right, and generally they were the best at polling politics, it gave them incredible sales ability for selling to, I don't know, BP or Shell, and the quality of how the public viewed the quality of their petrol pump and stuff like that. There's JD, Kainos, Rightmove, still doing pretty well, and is absolutely dominant in its industry. We all know what Rightmove does. It's not really a growth market in the same way as it used to be, and it has not gone outside the UK.
If we come on to the ones that fell to earth, pick one or two. I'm also especially interested. What you'll notice here, everyone, is that made money, yes or no. Look at how few. Even though these ones fell back to earth, you managed to make money on it. And again, ASOS is great. 85p. What did you say? £72. Sold at 47. That's a great. It's a very good story to say. Listen, it wasn't the best, and we made it.
Maybe if we're looking at the bad stuff at the bottom, independence insurance downwards. All these companies have gone under, and quite often for reasons of basically there's some kind of dodgy accounts going on there. I'm slightly careful what I'm saying here, but actually the finance director of this company, and I think this company, is certainly found guilty of fraud and things. And Patisserie is an interesting one. Do you remember Patisserie Holdings? To be a bit careful because I believe there's a court case, against management. It's currently in progression. So there's that. And AIT, a software company, a couple of their senior executives went to jail for issuing false trading statements, saying the company is doing really well when it wasn't. So that's a false market, and it's you get a prison sentence if you are found there. So there's two things I took out of this. One is you've got to be, and all these people, I think, were chartered accountants, but I always ask the question of the finance director of a new company, are you a chartered accountant? And actually, there are listed companies out there that are being run by people that are not chartered accountants. It's even better if they're a Scottish chartered accountant. And you don't want any old other sort of accountant. It's got to be a chartered accountant.
Yes,
is what I find. But it's an important thing. NMC was a healthcare business based in the UAE. I believe the founder is currently I don't know. You can research it if you want. I won't say any more about that then. I think I've said enough.
Yeah, exactly. Let's go on because so we'll take a couple more minutes because then we'd like to get some questions from the floor. But this one we could talk about forever. But
okay.
the one that I do really want you to talk about though is that one there. Just a bit of your thoughts on that.
New issues is a little bit more difficult because you cannot depend on the matrix because the matrix needs earnings forecasts momentum, it needs price momentum, it needs all sorts of things that just there is no data. So you have to fall back on basic fundamental analysis. And some of these factors point towards things that you need to be looking at, apart the quality, growth, and momentum. So that's just a few other things to point out here. Themes can be helpful, and I think our funds have benefited greatly from basically the online model. If you remember, there was the tech bubble, year 2000, 99, 2000. Tech companies went to the roof and then they collapsed, and nobody would touch them for years. But underneath it all, there was a number of models, that are revolutionary models that were changing industries. And I think where we were, our matrix was picking up on this. But the theme, and it's a theme, was starting to work really nicely. That's where ASOS came from, Abcam, Hargreaves Lansdown, Money Supermarket, even things like Jet2, the fantastic air company, Europe's favourite airline. Online booking of tickets is very important to that. So that theme was massively successful for us in the 2005 to 2010-11. Founder-run businesses, we talked about that. Bolt-ons, mergers. It's an important part of building businesses. I actually prefer companies that can grow entirely organically, but not every company can do this. But there are a number. But what is key to us is the acquirer has got to be a good deal bigger than the company being acquired, and the acquirer has got to have control, and it's got to assimilate the business quickly. Those are the ones that worked, and there's several companies that do very well on this. Diploma, Halma, Spirax, Rotork, things like that. And a merger of equals is I'm very careful what I say here, but it's a bit of a recipe for disaster. You've got two cultures, and I don't have to look further than Aberdeen for this. You've got two cultures. It takes years to get them aligned. Now, obviously, they've been aligned for the last 3 years, but it probably took 3 years to align the cultures, infighting, everybody sharpening their elbows. I thought, well, they're going to dismantle my smaller company's business. And I had to sort of kind of make sure, keep everything together, which fortunately happened. And so joint chief executives aren't a great idea either.
No comment to anyone there.
So markets are dynamic. Cut out the legwork. Smaller companies, you're never going to have a team of analysts. You need to matrix. Look at 100 companies instead of 1,000 companies. On new issues, I suppose, I've given you a lot of the pointers there on exactly what we're looking for in businesses. Company meetings are quite important. And sometimes little subliminal things can put you off a company or turn you on a company. And on the negative side, I've had finance directors burst into tears That's probably not a good sign. I've had a couple, you know, where our offices in Mouth and George Street. A couple of them suddenly got out, left the room, got their coins out, fed the meter, and come back into the meeting. And I wonder where are they off to? But so they were just there to feed the meter in case they got a parking ticket. And I thought, it's a strange way to behave. But anyway, I thought, well, he's probably got an eye for the costs. He's really got an eye for the costs. So I took that as positive. Any sign of out-and-out lying, and that was a sales signal. I remember even being told, in retrospect, by a company, Harry, this is a Welsh guy. I'm not very good at Welsh. Yes, I told you. I picked him up on something. Yes, I told you a little white lie, he said. That's a hook. I think we'll probably sell the shares. The little subliminal things. And even, well, I don't know. Can I tell the Jet 2 story? I'll tell you one of them, because I got a lot of time for this company. And the founder was a former... if the Wikipedia is correct, he's a former RAF pilot. He won aerobatic competitions and the like. And he set up the business. He had an air freight business, and he converted it into passengers. And he managed to buy a load of jets off Ansett when it went under during the 2001 or something like that. I think it was 9/11 or something like that during there. And I did a little research on him, and I knew this is odd. He doesn't normally like investors. He's very he's a really nice guy, but he can be a little prickly. And I saw that he'd been cautioned by the police at Manchester Airport for being basically abusive to the Jet 2, the ground staff that were handling the flight. And I asked him about that. I said, oh, yes, I do this. I do a lot of spot checks. I go on flights. I check that our customers are getting great service. And that was why I did it. And at that stage, he said, I'm really going to go full on this and just make sure that customer service is the best it can be from Jet 2. And I think you'll probably agree that actually Jet 2 does provide the best customer service. And if you can get a flight and it suits you, probably get Jet 2 as opposed to any other airline. So there you go. That's my plug for Jet 2.
Amazing corporate culture.
Yeah.
I got a Jet 2 today.
There you go. We have a consumer. I'll let you think about whether you want to say anything else. But one question, our last question from me, and then we'll go to the floor. But the last question from me is the state of the UK market. You talked about AIM, how you feel that's an important market, new issues. Do you want to say anything on that?
My ex-colleagues who are on the team now, Abby and Amanda, Abby Glenia, Amanda Yeaman, they're on the front page of the second page of the FT Week Saturday Wealth section, and what they're pointing out, smaller companies have never been this cheap. They are the most hated. The UK small caps, the most hated sector of the market over the last 10 years of anywhere in world investing. And now you might say, well, you're being a bit inconsistent here. I would say, well, maybe it's time to have a look at this market, because there are plenty of good companies within smaller companies at very, very low ratings. Now, you might say, well, you're going away from running your winners, but I think it is slightly different when it comes to asset allocation. So the UK is cheap, and in some ways it's cheap for a reason. It was never helped by the exit from the European Union. Was kind of definitely unhelpful. But the US has taken everything by storm in the last 10 years anyway, and probably longer. And particularly half a dozen stocks, 7 stocks in the US market, representing, I think it's, correct me if I'm wrong, maybe 20-30% of the overall market. 34%. the US equities represents 73% of the world market capitalization, and that's gone up from 45% 10, 15 years ago. So it just kind of shows you what's happened. Now, America is a great place. It's sort of the home of capitalism, and you know they clearly work to continue that. But be careful what I say here. But things are kind of changing quite rapidly, not necessarily for the best over there. We'll have to wait and see. So watch out for that. Keep an eye on that. And there are various other sectors in the world that are looking really remarkably cheap.
I couldn't agree more, and I would also add that it's really important for our companies, for our corporates. If we're not investing in our corporates, who is investing in them, and where are we getting new ones from?
There's one or two unhelpful things, and one of those, the new issues market is pretty dead at the moment, and smaller companies does thrive on new companies coming to the market, and AIM is I think at the end of the day is. We've made good money from AIM, and generally speaking, 25, 30% of our holdings are in AIM stocks. So there's a lot of rubbish on AIM, but there's if you're selective, there's some, and you use exactly the same criteria for buying stocks for AIM as if it was a full list, then that should keep you out of trouble.
No, it's brilliant. We should take questions from the floor, please. I think David has a microphone there, so launch away. Or Russell.
Hey there, Harry. We've spoken a lot about your time as a portfolio manager, but what about your time as a leader of the smaller companies franchise at Aberdeen? Has there been any kind of mistakes made during that time as a leader, or what were the things that you enjoyed about that role, or anything to say around that?
I've made so many mistakes. It's not true, and to be honest, the staff turnover within the smaller companies team has been way higher than it should have been. I'm not a particularly good man manager. To be honest. Maybe I need to take the blame, but I'm not going to take the whole blame here. And one problem is that if you work for a listed asset manager, if you're doing well, what happens is that all your competitors try and recruit your number two or your number three. And I had a situation in 2002 when two of my team, and that was half the team, left to join Scottish Widows. And it was just when we'd won this huge piece of Norwegian business. And Norwegian said, no, your team's only half the size now. We're not giving you that money after all. And this happened a second time. We lost a very good fund manager to Artemis. And then another one retired and then went to work for a firm down south. We lost quite a lot of good people, and there were one or two people that it was okay to lose. But at the end of the day, you want to have a stable team. And the beauty was, in the last 5 or 6 years, we have had a stable team, pretty stable team. And certainly in the 5 or 6 years prior to my retiring, we didn't lose anybody, and it worked really well. And I think the thing you cannot depend if you build. I think it's important to build a business within a business. And UK smaller companies is quite a narrow niche, so it's quite good. The matrix works in Europe, works globally. Some markets better than others, but we were able, on the back of our success in the UK, to build a similar franchise in Europe and globally, and win external pension fund accounts, and smaller companies is less exposed to passive fund competition as well. So there's lots of things to consider. I made a lot of mistakes, but not all of them were my fault. And in any case, the business has had its ups and downs. It's still having its ups and downs, but it has grown considerably over the last 20 years.
Harry is here for chats one-on-one. On you go, Hamish. Hamish.
Robert Farragut, Harry.
We used to work together.
We did, but I remember you saying that when small caps are doing well, it's because you've got more company. In smaller companies, you've got a mix of companies going up and down. So when they're struggling, it's because you've got a whole bunch of big companies that are on their way down, and when they're doing well, it's because you've got more smaller companies growing fast. Where do you think we are on that today, and how has the private equity world changed that? Because we're hearing that a lot of the smaller companies, smaller growth companies, are just staying private for longer.
Well, he's asking you sort of slightly hit the nail on the head here, is that private equity is growing and growing, and they haven't got the discipline of seeing their share prices moving up and down, so they can just, also slightly careful. Put it this way, you can argue about some of the valuations that private equity puts on companies in portfolios. And with markets low, you made the good point that we need new issues to keep things going, to see all the new ones. And if companies are not going to come to the market unless valuations are a bit higher, and it's worth their while selling equity at a higher price and maybe even raising money at a higher price. So we're not really in a good place for that at the moment. But this isn't the first time we've been here. Go back to 2003, after a massive bear market from 2000 to 2003. There are no new issues coming through. And also in the aftermath of the banking crisis in 2009, 10, 11, you saw no new issues for 3 years. So I've not given up hope, but you're right, we're not seeing signs of change just yet, if that answers your question.
Hamish, did you have one? Or?
This is a bit naughty.
Uh-oh. Hamish.
It's just to do with Standard Life, not to do with your area, but it was interesting. As an investment trust analyst, there were a lot of IPOs going on. And the Standard Life always said no. For 30 years, they never took an IPO until 1999. And they took a 20% stake in Amarinda Technology. You can imagine what happened to that. I think they lost 60% of the money. So it's interesting.
Is this a point of information?
Yeah. No question. No question. Observation. I think the keeper has a question.
It's your treat. You get to have one question from Russell.
Harry is here as well. As per usual, there are drinks
Harry,
afterwards.
First of all, congratulations on your Northern Irish accent. We know where you live. Everybody wants to revitalise the UK stock market. What would Harry Nimmo do? How would you revitalise it? You get one idea, 2 ideas, 3 ideas. What would you do from a policy stance to revitalise it?
Hospital pass there from the keeper.
Okay, I think I'd probably have UK join the European Union. I think that would be helpful. I don't have terribly strong views on these things, but what I do know is that if you're part of a larger economic body, that's generally better for the economy. And if you look at all these charts, you see all these charts of GDP growth in the UK, and it's been going nice. Not an odd blip when there's a banking crisis, but it's rising and rising. But then 2016, it's sort of gone a bit. The growth isn't as quick, and it's sort of slowing down. It's turning into a bit of a plateau, to be honest. Now, I think a little bit of that is to do with the leaving the EU. I would say there needs to be a government that is actually right behind business and being supportive of business. And we can talk about Scotland, but I'm talking about the UK really here, and I think the UK government has to demonstrate that. I remember I got occasionally get people from civil servants come and ask me, what can we do about the stock market to get it moving? And one thing I made a big point of, why don't you allow AIM stocks, whoever constructs indices, into the all-share index alongside fully listed companies? I think that would help make the AIM market a little bit more vibrant. I mean, it's all based on scale and size as well. And I thought that is important to really attract companies to list on AIM and smaller companies to arrive on the market and be investable. I was completely ignored. I mean, I never heard anybody even talk about that. So there are one or two little tweaks. I also reckon that you should basically be a bit more forceful, encouraging pension funds, and this includes government pension funds, invest in UK stocks. What we've seen in the last 5-10 years, and I know there's one or two private clients, stockbrokers in the room, so they can take the blame for this. 10 years ago, your average Joe Public had maybe 40% of their investors in the UK and 40% abroad, and let's say 20% fixed interest. Now, it's 4% in the UK. I mean, you probably all got brokers advising 4%. It's 40 to 4. And everybody's in the US and Europe and Far East. So, I think pension funds need to be encouraged to put a little bit more of their assets backing British companies.
I agree.
I think that would help.
Harry is here, and we will chat afterwards, so please come up and chat. I've been asked to announce the next one, or to advertise the next talk will be on April 24th. Do I have the right day? April 24th. John Kay will be returning to the Library of Mistakes, so do mark your diaries for that. And if you could join me in thanking Harry Nimmo. Brilliant.